So the next one, accounting, generally accepted accounting concepts consist of accounting period concept. So accounting period concept, basically what it is means, you need to prepare your books of account for a particular accounting period. That is what accounting period concept is. So the accounting period concept, accounting should be done for a particular period. That is accounting period concept. So how this concept emerged, in the earlier period, venture type of business, as I said, a few ventures will be started, and soon after their work has been done, they used to close down their business and they used to prepare their profit and loss account and balance sheet, whatever. But gradually, what happens? They started to take up their business one after another, one unit after another unit. They started one process after another process. They have started. So this continuation, they started to take up more businesses without winding up the earlier business. So this continuation in the nature of business resulted for the development of accounting period concept. And moreover, we have joint stock companies. We have many joint stock companies which started to operate, and these joint stock company started to operate for a longer period. And moreover, there are some statutes, means there are some competent authorities who made a periodic preparation and presentation of financial reports as a compulsion, as a mandatory. And this way the corporate world, corporate sector, they have started to prepare their reports periodically, normally once in a year. So we have financial statements, right? We prepare financial statement for a particular period. That period we used to call as accounting period. So the outcome of these things means the adventure of joint stock companies and the authorities a mandatory requirement to present financial statement for a particular period, having the concept of continuing means running the business for a longer period. All these necessitated for the development of accounting period, for the development of a period during which a financial statements will be prepared for particular that period. That is the concept of accounting period. So the outcome of this is lead to the emergence of accounting feature for a periodical measurement by splitting the business longevity into annual intervals. So under going concern concept, in the last video I told you that the business will run for long. 100 years a business can run. So but we cannot keep ourselves for 100 years to be waited to get to know how the company is performing, right? Because the company will, if accounting period concept was not there, what happens? Company will run for 10 years, say for example. Then how the company has been performed, we need to know. Then we need to wait till 10 years, because they prepare their financial statements at the end of 10th year. So this longevity has been divided into annual intervals because of accounting period concept. So accounting period concept basically speaks about the financial statements should be prepared for a particular accounting period. The accounting period, normally it consists of a 12 months period. We prepare financial statements for a 12 months period. That period we call it as accounting period. So normally 12 months period is adopted. Companies use normally either calendar year. Calendar year means Jan to December, or fiscal year April to March. But the Companies Act and the Banking Regulations Act, they stated that accounts should be prepared for a period of 12 months, and this 12 months should be called as an accounting period. However, International Financial Reporting Standards and Ind AS, now they call this accounting period as financial year. So the company used to prepare their financial statement for a period of 12 months. However, when the company they change their reporting period, if they prepare their books of account for more than 12 months or less than 12 months, then they have to disclose why they prepared their books of account for more than 12 months and what is the reason for less than 12 months, that they have to provide along with their financial statement. That is the concept of accounting period. And the next concept is verifiability or objectivity concept. So the name itself is indicating verifiable, means your accounting transactions and accounting treatment which you have recorded in the financial statements should be backed by the evidences. should be backed by the verifiability concept. That is the concept of verifiability. Verifiability concept, what it seeks, since the reported information is used as a base for the purpose of taking decisions. So investors take decisions based on the information provided in the financial statement, right? So when the information provided in the financial statement, that is the base to take up the decision, then such a financial statement should be true, right? So it has to be truthful, and this truthfulness of a financial statement uh, only possible when the organization reduces the scope for intentional distortion, bias or fraud. So in the financial statement, uh, whatever the financial information have been presented, that information should be truthful one, and we can say that information is truthful one when that is free from bias, free from errors. And this free from bias and free from errors can be achieved only when they record and report those transactions and events which have proper evidences. See, a company have purchased a asset. So simply company cannot record 1 lakh, 2 lakh, 3 lakh according to their wills and wish. They have to show the vouchers. They have to show how much exactly the cost they had paid. That much only they are supposed to record. Otherwise, what happens at the end of the accounting year when verification happens about the accounting transaction, auditors will do the cross check. At that point of a time, they will cross check a transaction with its vouchers, with their concerned receipts, concerned documents, isn't it? So that is the concept of verifiability. So the transactions which you have recorded in the books of account should have proper evidences. This concept specifies that all the entries of business transactions should solidly be supported by the evidences like documents, deeds, invoices, vouchers, and which are completely objective and subjected to verification. So when you are recording a transaction, that transaction should have supported documents. So that documents will be shown when you are preparing your books of accounts. That is the concept of verifiability. So there are some other transactions also we have where there is no evidence of happening of the transaction. Say for example, amount of cash paid, cash received, we can have proper evidences because we have the receipts of payments and receipts of receipts we have, right? But there are some other items which we are also having, but they do not have proper evidences like debts, doubtful debts, and the annual depreciation provided, amortization of research and development cost, goodwill written off. These are a prorated common cost which have been proportioned. So all these things there is no evidence because depreciation we charge according to the company's policy and according to the guidelines provided under generally accepted accounting principles. For depreciation, how much we have charged, there is no supportive document. In the same manner, for doubtful debts also, we do not have any proper evidence. But these doubtful debts, annual depreciation, amortization, returning of goodwill, and treating the common cost at apportioning the common cost, prorated is nothing but apportionment of common cost. All these things should be done based on the past experience. So when we speaks about verifiability concept, it only meant for those transactions which are having evidences, but for those transactions where we cannot get the evidences, then we have to record the transactions, we have to record it based on the past experience, based on the past experience, objectivity and estimation which we have made in the past. Accordingly we need to made nowadays, I mean so today. That is verifiability concept. So basically verifiability concept tells you when you are recording a particular transaction, that has to be backed by the evidences. That is verifiability concept. So the next one is dual aspect concept. So dual aspect concept, we have in balance sheet an equation, right? Capital plus liability is equal to asset. That is what dual aspect concept is. So it is, see, every transaction have two entries. One is debit entry, another one is credit entry. That is what dual aspect concept is. It is based on the double entry system of bookkeeping, where the entry made for each transaction is composed of two parts. One is debit, another one is credit. Say for example, if you have purchased a machine, then machine comes to your organization as an asset, but against to that you need to pay cash, isn't it? So we have to effect of a particular transaction. Here the transaction is purchase of machine, but that purchase of machine leads to two effects. One is acquisition of asset, another one is payment of cash. So every transaction has either it's both the origin and destination, both the source and application of fund. So both the transactions we have to record. That is as per dual aspect concept. You cannot only record that acquisition of machine, along with that you need to show that how much amount has been paid for that. So that is the concept of dual aspect. The next one is cost principle. So cost principle speaks about, the name itself is telling cost, means the transaction should be recorded on cost basis. That is cost principle. But there are few exceptions for this principle. Say for example, provision for doubtful debts, depreciation, for recording the investments and useful life of asset. For these kinds of item, cost principle we cannot apply, because here we cannot record the transactions as per the cost, acquisition cost. So that's why these, excluding these other transactions, we need to record it on the basis of cost principle. Say for example, if you have purchased a machine, you need to record at what cost you have purchased, what is the cost you have paid for that machine, that you need to record. That is cost principle. And next we have matching principle. Matching principle means you need to match the revenue and expenses for a particular period for which you are going to measure the income. Say for example, if you are preparing your books of account for the year 22-23, then in order to know whether your company have profit or loss, then you need to match the revenues and expenses which you have incurred and earned during the year 22-23. That is matching principle. So matching principle tells us to match the expenses against to the revenues in that period where it has generated. Means if you are generating your revenue during 22 and the expenses you are incurring during 22, those we need to record. So that is matching principles. The revenues of particular period should be matched against the expenses of that period. So previous period expenses we cannot match against the revenues of current year. So matching principles basically speaks to record the transaction by matching the revenues and expenses of a particular period. That is matching principle. So how are we going to match with matching principle, that we will see, but we need to know how we are going to ascertain the profit. See, we need to ascertain the profit based on one formula, that is sales minus cost, right? So means a revenue minus cost. So what revenue we have earned minus what are the cost we have incurred, then we will get either profit or loss. How we need to check the accuracy of the profit? See, if you understate cost, then profit will be overstated, then the company report higher profit. When they report higher profit, they need to pay taxes, they need to pay dividend. If you overstate cost, profit will be understated. If you understate the profit, what happens? The implication is negative on the shareholders. There is a chance that they may withdraw their money. So we need to follow systematic procedure in order to ascertain the profit. What was ascertain the profit? In order to ascertain the profit, we need to match the revenues and the expenses of a particular period appropriately. So how the matching process will have? We need to recognize the revenue, we need to calculate the cost, then revenue minus cost, we will get the profit. So matching revenues and the cost to determine the profit is the matching process. So here, in order to recognize the revenue, we have four basic ways. So revenue recognition means the sales you can the sales can take place on point, cash sales, what we call, that is point of sales method. Through this method also we will have revenues. Then collection method is nothing but when you have credit sales. So when you have credit sales, we will have collection method of collecting the revenue. Then installment method we have. So there is a chance of selling the goods on an installment basis, like for electric items like a refrigerator, or for vehicles we have installments method, right, where we will purchase the asset but we will pay the amount on an installment basis. So the company will realize their revenue on an installment basis. So that is also real revenue recognition, one method. And then we have percentage completion method. Percentage completion method in the sense, say for example, if you have taken the construction of roads, and you will realize the revenue as soon as you complete your work, like 10% of work if completed, no, you get 10% of your revenue. 20% of work gets completed, then 20% of revenue you will fetch. In that is percentage completion method. As long as your work will complete, according to that percentage, revenue recognition will be happen. So by these methods you need to recognize the revenue or realize the revenue, and the cost what you have incurred, you need to match this revenue minus cost, you will get either profit or loss. This entire process we used to call it as matching process. Now how cost we will identify. So basically cost, we have expired cost and unexpired cost. Unexpired cost means nothing but the cost of expenditure which you have incurred on acquisition of asset. Expired cost means the cost which you have incurred on revenue items. So that we will call as expenses or the losses. So you need to identify the cost what you are referring, is it a expenditure or a expenses. If it is an expenditure, then that will be an asset part. If it is an expenses, then you need to show in the profit and loss account. After calculating revenue and after calculating cost, finally you get to know the profitability, either profit or loss. So how you are going to calculate the profit? After matching the revenues and the expenses. That is the formula to derive profit. Yes, so the next principle which we are having is realization principle. So realization principle. What is realization principle? Realization. So see, we have sales, right? In a company used to sell their goods and services. When they sell, they get the revenue. So when you going to sales, when we speak, we have cash sales. At the same time, we have credit sales. So when we have cash sale, we will get the cash at that point of a time itself. But when we have credit sale, we get the amount later point of time. But the transaction had happened on that date, right? So this realization principles tells us you need to record the transaction and their implication, not anticipation. So if today the transaction sales had happened, we will record both the cash sales as well as credit sale. But profit on credit sales, when we generate, then we will record. But we will record both the cash sales and credit sales. This is the concept of, this is the principle of realization. So realization principle speaks about you need to record the transaction and their implication, but not anticipation. Even though credits on even though we have sold out the goods on a credit basis, but there is a promise, right, that debtors will pay back the amount. If they won't pay, we will estimate that as a bad debts. So that is future anticipation. But we will but the sales had happened, so we need to record that transaction. So that is a realization principle. Realization principle speaks about you need to record the transaction when you are when transaction is happening, like if today you are selling goods on a cash basis or credit basis, both the transaction you need to record. So this realization principle works on the principle of accrual basis of principle. It make use, and according to that it works out. So basically, we will record accounting transactions. We record on a past basis, means what has happened on that basis we record. Though it records the anticipated effects of the events already occurred, it does not anticipate events. This concept assumes that realization occurs at the time of exchange of liquid assets. So in accounting we record the transactions which had happened. So realization principle will show credit sales as credit sales. So if today we are selling, it shows both the cash sales. If we are having credit sales, then we will show it as credit sales and debtors. That is the concept of realization principle. We won't show credit sales as cash sales. We have, because we have not realized the cash. When we will realize, that will become cash sales. Until unless it will be a credit sale, and that credit sales also we show as credit sales itself. See here one example I had quoted. Say for example, we had a sales of 2 lakh units at 200 per unit on cash basis, and another 2 lakh units at 205 per unit on credit basis. So here what happens? Cash sales we record. Credit sales also we record. 205 on 205 rupees per unit, 2 lakh units we sell, we will record that one also. But we anticipate bad dates on which sales? Credit sales, not on cash sales. So this, when we get back our amount, then this credit sales will become cash sales and profit we will show. This is the concept of realization principle. See one more example. Purchased 15,000 units at 20 per unit and sold 12,500 units at 25. So how many goods have been purchased here? 15,000 units of goods have been purchased at 20 rupees. So we will record that. But how many goods have been sold out at 12,500 units. So we will earn profit on 12,500 units, not on 15,000 units. So we need to record profit of how much? 12,500 units into 25 rupees. That is what we're going to record, not on this not on 15,000 units. This is the concept of realization. So therefore income profit can be recognized only on actual sales. Cash, whether the cash sales we have, credit sales we have, it doesn't matter. When we will realize, then we will have to record it. That is realization principle. Next we have cost principle. So cost principle, the business undertakings, they acquire assets, right? They purchase materials, they get facilities, whatever they want to undertake manufacturing activity, right? So when an undertaking acquires their property, goods, services, they have to record that transaction in their books of accounts. Then they have to record that at their cost of acquisition, that is cost principle. So cost principle tells all the transactions in event should be recorded at actual amount of money involved, and the cost concept requires that the transaction should be recorded in the books of accounts only at the amounts actually involved. If you have paid 2 lakh rupees to get a machine, then you have to record 2 lakh rupees. After 2 years, if its value is more than 2 lakhs, still you have to record 2 lakhs as per historical accounting. So this, in other words, they are recorded at the amounts agreed upon by two parties to the transactions. The following examples will help you to understand what exactly the cost principle is. See, in this slide, I had quoted an example. So ABC company is willing to pay 25 lakh for a specially made machine, as the machine is very essential for the purpose of producing its export oriented product. Why? But ABC company succeeded in buying the same machine for a price of only 24 lakh. This transaction is therefore recorded in the books of accounts of ABC company at 24 lakh actual price of machine, but not 25 lakh. So ABC company wants to pay 25 lakh, but they got the machine at 24 lakh. So at what rate you will record the machine? 24 lakh actual cost paid. That is the cost principle is. If a company succeeds in obtaining an asset without paying anything, then this asset would not be recorded in the books of account of the company, as it has not paid any money. Say for example, if the company had acquired an asset without paying money, then that transaction we will not record in the books of account on the cost as per cost principle. This is cost. Yes, here we have systems of accounting where we follow cash system of accounting, accrual system of accounting, and hybrid system of accounting. So basically, a cash system of accounting means we will record the transactions which are of cash in nature, cash nature. So the nature of the transaction, if it is of cash, then we will record this transaction, that is as per cash system of accounting. And accrual system of accounting tells us to record the transaction whether we are getting the cash or not. Credit, if it is on credit basis, still we record that. That is accrual system of accounting, because in future we will get that. That is accrual system of accounting. But hybrid system of accounting is a combination of cash system of accounting and accrual system of accounting. So in hybrid system of accounting, we record cash transactions also as well as credit transactions also. This is all about your systems of accounting.